My name is Phil Strano. I'm Yarra Capital Management's Chief Commercial Officer, and I'm delighted to welcome you to this afternoon's webinar with Roy Keenan, Yarra's Head of Australian Fixed Income, and Phil Strano, our Senior Investment Manager and Portfolio Manager for Yarra's Absolute Credit strategy. Very shortly, Roy and Phil will provide an update on the firm's observations on the outlook for Australian credit, given the backdrop of the COVID-19 pandemic, and how this is impacting our assessment of value, and where the team is seeing opportunities in the current environment. Before we get started, just a couple of housekeeping items. Firstly, you're listening to this webinar using your computer speaker system by default, and all participants are in listen-only mode. You'll have the opportunity to ask questions at any time throughout this session just by typing them into the question pane of your control panel. Just look for the question mark symbol, and we'll look to address as many questions as we can at the end of today's formal presentations. With regards to the structure of today's session, firstly, we'll hear from Roy for 10 to 15 minutes, and then for something a little different, we'll run a Q&A with Phil discussing some of the topics we've been covering with our clients, which we think will be of interest to you. Post that, we'll open up to broader questions. Our aim is to wrap up a little after 3:30, and with that, I'd like to hand over to Roy Keenan. Thanks, Roy.
Thank you, Vito, for the kind of introduction. What I'd do is thought I'd start off with page 4 today. This is a slide that I stole from one of the recent decks from Tim Toohey. But you know, one of the reasons why I feel this is important is that Tim, early days during this whole pandemic of COVID, actually did call the V-shaped recovery very well. And essentially his view on the V-shaped recovery was around Australia doing a great job of containing the outbreak of the virus and our lockdown that we've experienced being a short one. As we know, that in Victoria, that's changed a little today, but generally, if we look at the broader Australia, you know, Australia's doing a great job of containing the virus. From the perspective of the V-shaped recovery, you know, and why it matters from a credit perspective, I think it all says that in the headline is it's what comes after the V that really matters. And from my perspective in credit, we're coming to a very important point of the cycle. Obviously, we get to assess the impacts of the second wave, whether and what's been going on in Victoria, but also what the impacts that potentially could come along if that was to broaden out into New South Wales, Queensland, and the rest of the country. But also from a credit viewpoint, you know, it's been a pretty tough 4 to 5 months for a lot of companies out there. And the next 4 to 5 weeks, we're going to be getting the companies reporting through the company reporting period. And what we'll be able to see with the results that will come is that how companies are dealing with, you know, the COVID shutdown, the outlook they have, and from our perspective, it will help us identify who the winners and losers are and where potential risks lie for the portfolio. So if we turn to page 5 and we focus on you know, how the markets have recovered from a V-shaped recovery. And the one thing I would say, if I look back through time and some of the cycles we've seen, and obviously the GFC being the closest to our memories, the actual V-shaped recovery has been very similar to the GFC, you know, especially if you've picked the low of the market. And in some ways, if you did pick the low of the market, in my view, that is the low-hanging fruit. And it's a similar scenario, you know, with the pandemic today. But if we look at the equity market response, very much V-shaped. You know, the US appears to be outperforming on face value. But if we were to put that chart into Aussie dollar terms, the US recovery has only been slightly better than what we've seen in the Australian equity market. And if we focus on, you know, the credit market in Australia, once again been, you know, pretty much a V-shaped recovery from the credit spreads, which have been inverted on page 5. And from my experience, initially the US market was outperforming. Australia has pegged back in that grey line, which is represented by the Yarra Enhanced Income Fund. And then just over the last couple of months, we've actually seen US once again, or over the past month, US starting to outperform credit spreads in Australia. I think from a perspective of the market today, it's a similar story to the GFC. Once we came out the other side of the global financial crisis, from a credit markets perspective and as a manager of credit, the alpha opportunities out in the marketplace for those managers who do their homework and do a lot of research will find those alpha opportunities. And I think coming out of COVID today is a much better marketplace for us to deliver alpha than what it was going into COVID-19. If we turn to page 6, and one of the things that we've noticed about the market today potentially can be pointed in some of the policy decisions that have been made over the last couple of months. And one I would highlight today is on page 6, which is the announcement by the Reserve Bank to actually help promote liquidity in the corporate bond market. And what they did was essentially expand their repurchase agreements. And historically speaking, it's been government, semi-government securities and AAA paper that has been eligible for repurchase, to be able to do repurchase agreements with the central bank. And what they did back a couple of months ago now is to help promote that liquidity. They extended it out into the corporate bond market. And what a repo does is essentially allow an ADI to actually purchase assets and then to borrow against that asset with the central bank at lower borrowing rates. So essentially, if you break it down, a bank can potentially get the economic value of an asset and borrow at that lower borrowing rate and lock in a spread, which can be quite an interesting pickup for a bank. So what did the RBA do? They announced that essentially to promote that liquidity in the marketplace, they would expand this repurchase agreements to allow corporate bonds for both ADIs and non-ADIs. To qualify, the paper must be senior and essentially be not subordinated, so senior unsecured. They must be rated by 2 agencies and must have a minimum credit rating of BBB-. Why I highlight this today is generally when you do get some sort of policy change in a period like what we've seen in the pandemic, sometimes there's sort of unintended consequences or impact in the marketplace. And from our impact in credit markets, our view on credit markets from generally the marketplace was when this policy was announced that there wouldn't be too much of an impact in the marketplace, but it would potentially help liquidity. What I'd like to highlight on page 7 is that, in my view, there's definitely been a large impact. As you can see on that chart, which actually is a long-dated chart back to 2000, it's the Australian Bank credit spread for both 3- and 5-year paper. And what is really interesting is that as we speak today, bank senior borrowing rates in the institutional market today are at their lowest they have been for 12 years. And I half suspect that and definitely lower than what they were going into COVID. And what I suspect is that is happening is that change by the central bank has actually encouraged ADIs or banks to actually go out and buy their own paper. And is, in a sense, if they're buying their own paper at 40 to 50 basis points above swap or above cash, they can actually repo that paper out and lock in 40 to 50 basis points. And I half suspect that's what's been driving bank senior paper to all-time, not all-time lows, but definitely post-GFC lows. What is really interesting about this is that if we turn to slide 8, is that are we seeing that flow through in other parts of the capital structure for the major banks? And what has been really interesting is that we have seen, obviously the rally in bank senior, and in some ways we've seen a very quick rally, that V-shaped recovery in the early part of March and April in both Tier 1 and Tier 2 paper. But what has been really interesting over the last couple of months has been that Tier 1 has sort of stagnated around that 375 basis points for 4 to 5 year securities. Tier 2 has probably outperformed Tier 1 over the last couple of months by rallying some 30 to 40 basis points. And I think more importantly, if we look at the chart on the bottom of page 8, what is really interesting is the rally in senior has started to make both Tier 1 and Tier 2 look cheap from a ratio perspective. Historically speaking, I went back and charted this for over 10 years, the ratio between Tier 1 and senior is historically around 4 times, which is what it was in the second half of 2019. But what we can see today is that Tier 1 trades at about 8 times the spread of senior, which even if we look back to March when we're at the height of the volatility and the sell-off in credit and both equity markets, the ratio only got above 7. So what we are seeing is senior is definitely making Tier 1 and Tier 2 cheap. And I half suspect what will happen over time is as people start to sell senior, they will actually start to look to rotate down the capital structure in the banks. And in some ways, we've already started to see that in the last 3 to 4 weeks in Tier 2, which has rallied around that 30 to 40 basis points, but still looks remarkably cheap at 4 times senior, which historically would be around 2 times senior. So has this policy decision impacted corporate bonds? And if we turn to page 9, what we can see on page 9 is that I've picked essentially 4 BBB to BBB minus credits. And what has been really interesting is that the same sort of pattern of behaviour as we've seen in bank senior with them trading at their lows has not sort of been replicated in corporate bonds. Especially over the last month or so, we're seeing sort of corporate bond spreads go sideways to slightly down. In the case of Downer, the rally in credit recently has been on the back of the capital raise they did to delever their balance sheet. So what is really interesting from our perspective is that although the central bank implemented a policy to help liquidity in corporate bonds, we're not actually seeing that risk-taking down to the BBB minus level. And in some ways, if we think about it, from our perspective, we're starting to see opportunities in this space where credit spreads in, good quality corporate bonds are now 100 to 150 points wider than where they were going into COVID. So if we turn to page 10, and once again, this is a chart that I have picked up from Tim Toohey, and which has just been recently updated with the recent announcement by the government to extend JobKeeper and JobSeeker. And I think what's really important about this slide was not so much how it looks today, but what it did look prior to the extension of JobKeeper and JobSeeker. And from a credit market perspective, the fiscal cliff that everyone has talked about in some ways has been flattened or in some ways moved out over the cycle. And in my view, the government is trying to reflect or trying to engineer a situation where the economy will start to actually come off this stimulus and actually look to be at a time when the economy is picking up. So in some ways, we're going to see stimulus and the policy support reduced as a time as Australia opens up and growth starts to return to the economy and activity starts to return. Why is this important from a credit viewpoint is that, prior to JobKeeper and JobSeeker being extended, the fiscal cliff was obviously going to be important from a credit perspective. And in my mind, in some ways, from a credit perspective, has sort of kicked the problems a good 12 months down the street, and in a sense, has given companies and also issuers out there the ability to manage their potential problems that they may be coming from this situation. One of those is on page 11, and this is one sector of the marketplace, the RMBS sector, which from really interestingly, from Yarra Capital's perspective, is that we had very little exposure to the RMBS market, and especially the residential market going into COVID. Our view was not so much that we were negative on retail property, but was more about the risk-reward characteristics there, and we felt that we weren't quite getting the returns for the risk that we were taking in investing into this sector. That has definitely changed post-COVID and where we sit today. You can see from that chart on page 11 that if we look at the A-rated RMBS and the triple B RMBS, you can see that the returns on offer in this segment are now some 100 to 150 basis points wider, depending on where you invest in the structures. So what we do like about this sector at the moment is that loans that are being written today are being written in a sort of post-COVID environment. So we think that the loan structures in this segment are definitely more favourable today than some of the deals we've written pre-COVID. You're getting paid for the risk that you're taking, and more importantly, we think that you don't, to actually get the returns that we've seen in the past, you don't actually need to take that much risk. So we are definitely looking at some of the A-rated RMBS categories there, where you're getting paid today the same sort of returns that you would have been by taking triple B risk pre-COVID. So we are definitely attracted to this sector, and in some ways we think that the property price declines that you have to see going forward for this sector to be a bit of a risk profile will not eventuate, and it's definitely an area of interest for us to add risk. And finally, if I turn to slide 12, and I look at recently some of the new issuance that we at Yarra Capital have participated in. In our view, we've definitely been seeing, definitely new issuance premiums in the marketplace for new primary deals. As you can see from the chart there, both Macquarie Bank have been very active in issuing Tier 1 and Tier 2. And if we think back to the GFC, they were also the bank that was probably the most aggressive in issuing into marketplaces when they first opened post-GFC. Brisbane Airports is another security that has issued. National Australia Bank come to the market in the over-the-counter Tier 1 market, which is the first deal of its type. And Port of Brisbane came to the marketplace last week. What is really interesting, as you can see, is that all those deals, for whatever reason, they definitely issued with a new issuance premium, what we'd call a new issuance premium. And especially if you think about all those issuers, in particular Brisbane Airport and Port of Brisbane, obviously very activity-based types of credits, with obviously traffic numbers down at Brisbane Airport, revenue down. But we view those assets as very long-term, and we see them as very low, volatile assets once normal activity picks up. Once again, we think that this sort of new issuance premium for especially people for credits that actually will be looking to raise money and repair balance sheets, we will still see quite superior returns in participating in some of these deals. And generally they have been more credits that are rated in that triple B space. I know I've touched on a lot of areas there. One thing I would say from our perspective is that, to this market going forward, as mentioned earlier, we feel there's a lot of alpha opportunities out there. But you really need to be focused on funds that have the ability to access all segments of the marketplace and provide a very diversified offering than being focused on one particular area of the credit market. And with that, I'll hand back to Vito.
Great. Thank you, Roy. And a big thank you to all for the questions we've received to date. Please keep them coming, and we'll look to get to them shortly. Okay, Phil, time for our Q&A. And as I said during the introduction, this is really about getting a better understanding and fleshing out some of the key topics that we've been covering with clients over recent weeks. So I've sort of grouped them into 4 key questions, if you like. And the first of those questions is really around challenges that we're facing as investors. And the question really is what unique challenges has the first half of calendar 2020 presented for credit investors?
Yeah, thanks, Vito. Great to be here. Yeah, certainly the pandemic has generated some, as a word that's been used quite often, and unprecedented, but I think we can definitely say that. But certainly from a market's perspective, both Roy and I were working during the GFC, and in many ways, the pandemic, being a black swan event, had a very similar rhyme and rhythm to the GFC and followed a particularly similar path. I mean, if we look back to the height of the pandemic uncertainty in late March, early April, with the lockdowns, certainly in Australia and in most places globally, we had a significant amount of uncertainty and volatility that really related to the perceived adequacy of the government response and what their policies would be. Overall, I'd say that we had a fair degree of confidence that much of the volatility, whilst it was definitely understandable, was in many cases overstated. And we deployed capital accordingly in some really fantastic opportunities. If I look back at the height of the market volatility, which I think was the 23rd of March, we saw tier 1 capital spreads of the credit margins that Roy's already touched on for major banks at roughly 900 basis points. This was three times the level from the previous fortnight. Similarly, we had credit margins across most traded segments of the market, whether it be corporates, RMBS and all like that, 2 to 3 times the previous levels prior to the pandemic. So whilst we thought some of that was warranted, we also understood that some of it was due to just a classic run on liquidity, which would basically be calmed over time as the market absorbed the ramifications of the lockdowns, but also got significant comfort from government policy, and they came thick and fast, and the market settled down quite a bit. And we were able to deploy capital in some really, really, really good opportunities. Look, and aside from markets, what does lockdown mean? And obviously we're here in Victoria, and as many people will talk about it, we won't say it's lockdown, but certainly we're probably in shutdown 2.0 at the moment. Look, working from home has presented a new range of challenges. It's fair to say, but given the technology we've got, we haven't really skipped a beat. The technology, such as Teams and Zoom, has really driven really strong collaboration amongst all of us and maintained this optimal portfolio management. Ironically, when we look at this new environment, in many ways it's aided productivity rather than lessened it. And across the organisation, as an example, our meetings with companies and issuers and kind of unique interactions in that regard is up 30% year on year. So it just goes to show that this environment is certainly not hindering us in finding value.
Great, thanks, Phil. This next question is really an extension of the one we've just covered, and sort of centres around volatility. And the question is, as a credit manager, what tools do you have at your disposal to try and dampen some of the volatility the market has thrown up? Yeah, that's a good question, Vito. I mean, look, first and foremost, you've got to run a strong investment process. It's fundamental to everything that you need to do, especially during times of really strong volatility, such as we've seen. Running a strong investment process will enable you to outperform on a sustainable basis, through a cycle. When I look at specifically this period right now, understanding your credit exposures has never been more fundamental than during periods of heightened volatility. From our perspective, we're very lucky in the fixed income team at Yarra, in that we have an in-house equities team that we work with on a daily basis. Together we form part of the broader Yarra Capital investment team, and our unique interactions with them certainly aided us to come to grips with the COVID impacts for our credit exposures. Because obviously when you look at our credit or equities, the fundamental drivers of the performance of both of those is the underpinning cash flow. So certainly having access to updated views on the equity
part of the capital structure really helped us inform our decision in terms of credit. So in terms of broader detail process, we spent a lot of time looking at balance sheets and liquidity across all our credit exposures. In addition to that, we also looked at the longer term impacts post-COVID and how potentially COVID would hasten structural change in several industries and how we should position portfolios for that. So what we saw, for instance, in March, April, very attractive entry levels for IG credit. We also focused on lengthening duration in the portfolio, taking advantage of that extreme volatility that enabled us to pick up assets at pretty low valuations and enabled us to extract that kind of capital appreciation. Overall, having a wider opportunity set across ASX listed and over-the-counter securities, the benefits of that really come to the fore during a period like this, giving us a greater opportunity set to really kind of pick the eyes and drive the high risk adjusted returns for the portfolio. And the last thing I'll say on this topic is that what this period has really enabled us to do is, given that the spreads have pushed out, so it's really enabled us to improve the portfolio credit quality without necessarily sacrificing spread. So when I look at our portfolio now, it's really trending as a strong investment grade portfolio.
You mentioned picking the eyes out of the market or opportunities. I guess an extension of that is, Phil, perhaps you can run us through some of the opportunities you're currently seeing in the market.
Yeah, absolutely. Now, I know that Roy's probably stole my thunder a bit on a couple of these. That's all right, Roy. But when I look at the bank space, certainly when we look at tier ones and tier twos, we in terms of major banks, we remain pretty predisposed to having exposure in that space. We identified pretty early on that just wasn't going to be a rerun of the GFC from the banking perspective. The regulators had done a pretty sterling job since the GFC to de-risk bank balance sheets, and we knew that the capital buffers they had would be more than sufficient to cope with this COVID environment. So obviously, when we see spreads where they were, and even where they are now, especially in relation to senior, we feel quite confident in terms of deploying capital there. I look at corporate bonds and notes. Credit margins remain roughly circa double where they were pre-COVID. You are looking at strong corporate credit quality, triple B investment risk, with access to equity issuance if required to deliver balance sheets and really protect us in the position and capital structure. In the RMBS space, we are seeing a situation where it's enabling us to rotate into higher quality tranches without sacrificing spread. Some of the deals that we're seeing offering really strong subordination where you'd need to see 10 times the historical default rate, and 30-35% decline in house prices before your position is in peril. And we just see that as being quite unrealistic. It's not to say that we've been buying everything that's been presented to us. We certainly remain discerning. If I was to give one example of the deal we didn't do, SEEK did a tap of a 2026 subordinated note. That was a deal we didn't participate in. Not that we don't think that SEEK will be able to weather the COVID impacts. We think they will. We just think that the company's better served issuing equity at this point in the cycle than basically swapping more sub-debt for senior debt.
Great. One final one from me, Phil, before we open up to questions from the audience.
Yep.
On topical one, in a yield-starved environment, what are the key risks investors should be focusing on going forward?
I think the first risk they should be focusing on is interest rate duration risk. I had a look at the Oz bond index before jumping on the call here. It's currently yielding 80 basis points. Its duration is 6 years. If you're exposed to traditional fixed income portfolios right now, you have very little carry, very little protection. Any kind of normalisation of the yield curve will undoubtedly generate negative returns, and I think it's something that investors need to be cognizant of. In addition to that, ultimately from our perspective, we need to ensure that the risk is adequately priced into securities. Roy's given that example with Brisbane Airports. That was a deal that was really attractively priced. When I look at airports, admittedly at the moment, they're enduring their difficulties, but airports are, especially in Australia, a critical infrastructure. We have major capital cities that are huge distances between them and pretty poor train links. So airports will remain fundamental to our way of life for many, many decades to come. When I look at Brisbane Airport's capital structure and liquidity, that they are robust, and more importantly, they have major shareholder group backing them, made up of some of the biggest institutions, both in Australia and offshore. That 10-year deal that priced in the high 300s has performed, as Roy pointed out, and we think it will continue to perform as time goes on. Overall, it's all about active management and stock selection right here. In order to maximise risk-adjusted returns, it's really important to have a really strong investment process driving that. So basically, wider opportunity set as possible, being as benchmark unaware as possible, and not having as exposure to an index such as an Oz bond index where you have interest rate duration risk.
Great, thank you. We might turn to some questions from the audience, and we'll try and push through a couple if we can, given where we're at from a time perspective. Whilst you're on a roll, Phil, perhaps the first one for you. How do you expect credit and your portfolio to perform throughout the remainder of 2020?
Well, I think we're in a very advantageous position right now. For one, the portfolio doesn't have any interest rate duration risk. Let's say off the bat. It's a floating rate portfolio, so you're not exposed to the changes in the yield curve. When I look at the assets that we are putting into the portfolio right now, we are successfully rotating the portfolio into high quality names. The average credit rating is up 2 notches, so it's now a strong investment grade portfolio. It's yielding circa 4%. And the combination of all those things will drive strong performance throughout the remainder of 2020 and into 21.
Thank you. Roy, one for you, I think. Thinking about RMBS, how concerned are you about the prospect for a serious housing downturn?
Thanks, Vito. Look, I think it's just not just about RMBS from a credit perspective for us. It's about when we look at credit and we lend, it's about all the assets we lend against. And one particular focus for us has obviously property. So we've done a lot of research on residential, office, retail, and the amount of work we've done on that research, it's probably Phil's best place to answer that. But it's definitely when you're doing a lend against any of these segments, your asset coverage and your recoveries is the most important point. I don't know if you've got something to add there, Phil, on that, the research we've done on the residential side.
Yeah, so look, from a housing downturn perspective in terms of being serious, it depends on your definition of serious, but when I look at RMBS from our perspective, it's effectively priced for a downturn. We've seen that in terms of spreads and the subordination you're getting at a much elevated spread than you were, even 6 months ago. So it's largely priced in. And I also think that when you look at it from a fundamental perspective, there's a few things that sort of favour that downside protection for Australian housing. And one is obviously interest rates being so low. I mean, mortgage rates now, I think new homeowners can get mortgage rates under 2%, which is just incredible when you think about it. In addition to that, you've got really supportive regulators. The ARFM is providing liquidity to certainly securitise market at the moment, and will continue to do so as long as it's required. We've got a government that's intent on providing further stimulus, and will continue to do so, especially the housing market. And you've got the RBA, which remains supportive. And I think the other thing you've got to think about at the moment is that whilst population growth has taken a hit off the back of COVID and the international borders being closed, going forward, certainly the way Australia has performed in this pandemic has only sort of headlined Australia as a desirable destination for international migration, especially given what's going on offshore. And I think as soon as the international borders are able to be opened up, people will be well and truly looking to migrate to Australia, and providing a really strong contribution to this economy, and certainly limiting that downside in housing prices.
Yeah. I would just add to that as well, Vito, that we do model downside cases, across residential. We look at the diversification in some of the pools that we invest in, obviously trying to avoid concentration risk or being exposed to sectors of Australian residential that we may not want to take risk to. So, and that, I think Phil touched on this earlier, and that's why some RMBS we've been very comfortable to buy, and some we've let go and not been involved in. And ultimately, it comes down to that research and the work you do on trying to assess the pool of mortgages that within those deals that are brought to the marketplace.
Thanks, guys. Perhaps two last quick questions. First of those, Roy, you touched on the new issuance premia in the primary market during your presentation. Do you think those sorts of opportunities are still likely to persist?
Yeah, look, I think it's an interesting time in the cycle. Obviously, the companies that come to the market first in a marketplace like we're experiencing today are the ones with a need to issue. And I think post the lockdown, the company reporting period where companies will start to reassess their debt borrowings again, I half suspect that we'll see an increase in senior paper. But I think Phil touched on earlier the example of SEEK. I think if we look back over history, corporate subordinated debt has had its cycles, and I think we're in a stage in the marketplace where we might see corporate subordinated debt start to get issued again. If companies are reluctant to raise equity to protect their underlying credit rating, then the next cab off the rank for them is, if they don't want to raise equity, repair balance sheets, is to do subordinated debt. And we've seen very little subordinated debt issuance in Australia over the last 3 to 4 years because companies' balance sheets are in great shape. But I really do believe that is one potential sector of the market that we might start to see new issuance and potentially start to get some nice premium from that new issuance.
Thanks, Roy. One last one, a broader one. Any concerns regarding Australia's AAA credit rating, and what is your base case?
Yeah, look, I think from a credit viewpoint, it's very important. The sovereign credit rating. Obviously, we've seen S&P and Moody's come out just recently, and to back the current AAA rating. I think there's two avenues to this from a credit market perspective. Is if the sovereign gets downgraded because of increasing government borrowings, then generally the impact in the credit market will be only felt at the senior level of the Australian banks. So in a sense, senior unsecured would actually fall from AA- down to A+, and hence that would increase the borrowing costs for the banks. From a hybrid perspective, the sovereign rating being downgraded, if it's due to government debt, it's not an issue because the hybrids are actually, their credit rating is based off the standalone credit rating of the underlying banks that are issuing the paper. But if the AAA rating was downgraded due to Standard & Poor's having a negative view on the Australian economy and the Australian housing market, for example, then that potentially would impact both Tier 1 and Tier 2 credit ratings, and potentially in the case of Tier 1 for the major banks, moving it from current investment grade at BBB- to non-investment grade at BB+. But I think at this stage of the cycle, Australia's in pretty good shape relative to the rest of the world and where our credit rating stands.
Great, thanks, guys. Slightly over from a time perspective, so we might wrap up proceedings. Thank you for your questions. If we haven't answered them during today's webinar, we'll look to get back to you in the next day or two. But please keep them coming, and thank you for your participation. I guess finally, a massive thank you for today's attendance and your continued support. It really is greatly appreciated. We know it's trying times out there, and you spending half an hour or so with us on a weekly basis is greatly appreciated. If there's any questions following today, please feel free to contact myself, Ramal Hakopian, or Nick Green in the first instance. More than happy to help out. Two things to keep an eye out for. Firstly, an invitation for next week's session, or our next session coming out shortly. And we'll also try and provide a survey following today. Any feedback, as always, greatly appreciated. It just helps us shape and scope upcoming webinars. So, on behalf of Yarra Capital Management, a massive thank you for joining us today, and have a great afternoon and stay safe. Thank you.